It does take us to our talk of the tape, the risks and rewards of buying stocks at record highs. Goldman Sachs just upping its view of global equities today thanks to strong earnings and a Fed easing cycle. Our next guest bumping up his own outlook as well. Brian Belski is BMO's chief investment strategist. He's here with us at Post 9. It's good to see you. Welcome. So we obviously watching the president and Benjamin Netanyahu at the White House. We're trying to figure out what's going on with the shutdown. We expect arrivals from congressional leaders at any time, and if we do see it, we'll show it. But that's what you have to deal with, as I say, risk rewards of stocks at record highs. How do you see it?
We really do. I go back to my very first months in the business. My very first mentor was William O'Neill in Investors Business Daily, and he said, Belski, there's always something going on in the markets. You just threw a bunch at us, and I think you have to try your best, Scott, to kind of push that to the side and really focus on something that you and I have talked about now for the majority of 2025, is that this rally has been led by fundamentals. This rally has been led by earnings recovering. This rally is going to continue to be led by that. And that's why we felt so compelled to finally move our targets to our bull case, which we originally published in November of 2024, which was 7,000. So that number's been out there for a while. But what we really need to see are those earnings begin to accelerate. And our earnings number of 275 has been there for a while. We actually think that into next year, we're going to see another 8 to 10% earnings growth. So what we really think has gone on the last 6 months or so is that 2025, quite frankly, is set the table for Goldilocks for 2026 and 2027.
All right. So the headline here from you, just to make it clear, you raised your target back to 7,000 as a bull case.
Yep.
So when I sort of throw out there the risks and rewards of buying stocks at record highs, which ostensibly we are at, you see much more reward than risk?
We do, and quite frankly, we wrote in the piece too that we knew we would get a lot of pushback, like way to go, way to call the top Belski, or you're Pollyanna positive and all this kind of stuff. But what's wrong with stocks going up? It's actually a really, really good thing, number one. Number two, I think it justifies that. I think actually 7,000 by year end could be too low. I think we could probably go higher than that and then all of a sudden settle in 7,000. I don't want to just be as easy as the trend is your friend and like that, but we also have this notion of a lot of cash on the sidelines. We have a fourth quarter that hit traditionally, when you see a market that's up 15 to 20% the first 9 months of the year, the average return is like 5.6% going back to 1950 or so. So seasonality is involved, but also the believability of equities are back in terms of it working, and the believability of the U.S. markets to have some wherewithal is also back.
So I have a little bit of an issue with the Goldilocks moniker. Can you have Goldilocks with stocks not only at record highs, but with valuations where they are to historical averages? I don't know. Is that Goldilocks?
Well, Goldilocks is the notion of interest rates staying steady, earnings growth being positive, GDP growth being positive. Doesn't have a valuation metric to it traditionally, but I think that we're heading back. And I was a strategist back in 1995, 96. I think we're heading back into that era again, where toward the end of 96, you started to see a broadening out of the market away from just the consumer staples, high multiple stocks. So remember, too, that the multiples peaked in the 30s during the tech wreck of 99, 2000, really into 2000. So I think we got a long ways to go. I don't think we're anywhere, any kind of bubble territory for tech.
Inflation's higher than target. Can that be Goldilocks?
Well, inflation, I think...
Stagflation is a word that's tossed around. Is that Goldilocks?
It's an excellent point, and I think of the one thing that we need to be worried about is that if the Fed cranks interest rates down too fast, could that ultimately be something that would feed inflation? Remember a year ago when the Fed started cutting, 10-year Treasury went up, yields went up.
Oh, well, I have news for you. The long end of the curve has been up since the Fed started cutting this year.
Yeah,
just
so
now.
We actually think the yield curve is going to continue to steepen, and that'll be good for financials, and that's where a lot of the earnings growth is going to come out. But also, ultimately, that will help drive participation to broaden into small cap, into value, and the like. I think it's going to be, right now, I'm not going to give away my forecast for 2026 so far, but I think it's going to be really difficult.
Well, you kind of already did.
No, I didn't. I think that Goldilocks in a consistent kind of more normalcy type pattern, Scott, doesn't mean up 20 to 25%. I think it's very, very possible that we're going to enter into a period where stocks are up high single digit to low double digit, especially with the dividend. So let's call it near the historical average of 10 to 12%.
High single digit, but if you include the total return and all of that, you're better than that. But why only single digits?
Well, I think
if the environment's so great.
No, I think you have to underpromise and overdeliver, and I think the market has to prove itself, and the Fed has to prove itself in terms of how they're going to engineer this in the turn with respect to the dual mandate, and we'll see from here. But ultimately, especially when we're taking a look at the consensus numbers that we see from economists, but also our great economics team at BMO, interest rates are going to tighten in. So that's why we think what we think in terms of where we're going to go.
All right, hold your thought for just a minute. We're going to do this breaking news now with Leslie Picker, who has that for us. Leslie, what do we know?
Hey, Scott. In this closely watched trial of Charlie Javice, this is the entrepreneur who was convicted recently of defrauding J.P. Morgan into buying her college financial aid startup known as Frank for $175 million. Well, she was just sentenced to about over 7 years in prison. This was handed down at a hearing in Manhattan federal court just moments ago. The 33-year-old was convicted about 6 months ago on all 4 counts she faced, which was bank fraud, securities fraud, wire fraud, and conspiracy. She pleaded not guilty and is expected to appeal her conviction. J.P. Morgan declines to comment on the sentence. Scott, I'll send it back to you.
All right. Okay, Leslie, thanks for that breaking news for us. Just make the point that you were making again when I was sort of rushing you to finish because I had to get to that about the Fed.
Yeah.
The role that the Fed plays in next year and why you think it could only be a single-digit return kind of year.
Well, I think, again, I think that's kind of the bottom end of where we think we could be. And I think the Fed has to build some credibility back with the market, especially considering all of this tenseness with respect to the White House, but also what you mentioned in terms of inflation. Now, we have seen inflation be stickier than everybody thought, including ourselves. So I think that the Fed has to kind of thread the needle here a little bit. We ourselves didn't think the Fed was going to go 50 like most people thought they were. And I do think we're probably going to see at least 2 more cuts before the end of the year. I think if we are more aggressive than that, I think then the inflation thing comes back into play, especially if it hasn't fallen.